Sylvia's Traders Lounge, in partnership with Scope Markets, welcome you to yet another webinar where we learn, trade, and profit. We shall be giving you trading insights on technical analysis, fundamental analysis, risk management, and trading psychology. Today's guest is Steenbarger, and our theme is the psychological makeup of a successful trader.
So welcome, Brett. I will just read out your bio. Brett Steenbarger is a clinical associate professor of psychiatry and behavioral sciences at SUNY Upstate Medical University, Syracuse, New York. He works as a performance coach for hedge fund portfolio managers and traders and has written several books on trading psychology. His books, he has written several dozen peer-reviewed book chapters and journal articles on the topic of brief approaches to cognitive, behavioral, and emotional change. Among the books he has written are Psychology of Trading, The Daily Trading Coach, Enhancing Trader Performance, and his latest publication, Trading and Spirituality. He covers the psychology of traders and markets, emphasizing recent research and application in psychology and behavioral finance. Brett Steenbarger is an intraday stock index futures and S&P ETF SPY, part-time trader since the 1970s. We are honored to have you, Brett, and we will start by just asking how you found your way into trading and how you have managed to keep going for 40 plus years, now specializing in performance coaching and trading psychology.
Well, thank you very much for having me. I really appreciate the opportunity to speak with you. I became involved in financial markets in the late 1970s. After hearing about markets from family members and getting an interest in stocks. That was a time when I was in graduate school getting my degree in psychology. And so financial markets were always a side interest. My main interest is psychology. My main work is as a psychologist. But I followed markets and traded on the side as something that I found interesting and worthwhile. It wasn't until the year 2000 that I started actually working with traders and eventually wrote my first book, which is called The Psychology of Trading. Some traders in Chicago discovered that book and asked me to come work with them, and that led me to move to Chicago and work full-time with market makers in electronic futures. And I did that for a couple of years, and then I started working with investment banks, and then I started working with hedge funds, and I began my blog in 2006, TraderFeed, and became very involved in using psychology to help traders with their performance. And that's what I've been doing ever since. I currently work with many different firms. I do not work with individual traders. All my work is with professional traders at trading firms, applying psychology to help them with their hiring processes, to help them with their trading, to help them with portfolio management and risk management, and to help them become better at what they do.
All right, so we will just go right into your presentation because we only have an hour. So I hope you can be able to share your screen and then we will take up the Q&A.
Let's talk about the psychological makeup of the successful trader. You see my name below and the link to my blog, TraderFeed.blogspot.com. And my contact information is there if you have any questions. And also the blog site for the online free book that I wrote called Radical Renewal, which talks about the topic of trading and spirituality. So let's start out by taking a look at the characteristics of top traders. This is based on research that I've done at a number of different trading firms. The first characteristic is intellectual curiosity. One of the things that is most important for traders is the ability to develop sound trading ideas. The ability to see opportunity and develop ideas where other people don't see opportunity is really a function of creativity. And what we see among successful traders, ones who sustain career success, is the ability to generate new ideas, new ways of making money because of their curiosity. We also see among top traders a high degree of conscientiousness. Conscientiousness means a detail orientation. It means a strong work ethic. They are very oriented toward doing what they need to do, doing it well in order to succeed. To give you an example, I was working just yesterday, in fact, at a trading firm called SMB. They are mostly day traders in equities. And a young team of 2 traders who were developing sent me their review for January. And their review ran for over 200 pages. They detailed every single trade that they took, reviewed in detail every single trade they took, outlined exactly what they could have done better, and did that throughout the month so that they created a very detailed learning experience. That is a great example of conscientiousness. And notice that those traders are getting many more reps, many more exposures to trading patterns than the average trader. And I predict they will be successful for precisely that reason. The next characteristic of top traders is emotional stability. Some people are wired emotionally to have a lot of highs and lows. Some are very stable. They don't get too high, they don't get too low. If things go well, things don't go well. What we see among successful traders is that they're pretty grounded. They're pretty even-keeled. They don't have a lot of emotional highs and lows. It turns out that traders who don't have the conscientiousness, in other words, they don't have that detail orientation to their learning, and they don't have the emotional stability, that is a common pattern for failure in trading. That you really need at least one of those to be grounded through your learning process. Cognitive processing strengths refers to how we process information. We have different ways in which we can make sense of the world around us. We can talk with other people, we can analyze mathematically, we can write things down. There are many different ways of processing information. Some of us are very visual in how we process information. What we see among top traders is that they have some very distinctive cognitive processing strength, and they develop a trading process that makes use of that strength. Another characteristic of top traders is mentoring. What we see with successful traders is that they have been mentored by successful traders. The odds of someone learning trading all by themselves and becoming successful over a career are very, very, very low. Learning from someone who's experienced and successful is very important in any performance field, whether it's sports, performing arts, or financial markets. And finally, as a function of intellectual curiosity, innovation. Successful traders find new ways of making money in markets. They innovate. They don't stay static. Markets don't stay static. Markets are always changing. And so top traders are able to innovate and change to adapt to changing market conditions. One of the themes that I emphasize both in my blog and in the book Trading Psychology 2.0 is the grounding in best practices. Successful traders study what they do right, they study their successes, they learn what they do well, and their trading becomes an expression of their strengths, of what they do well. So let's look at a few best practices. The first one is keeping score. For instance, at the firm where I just mentioned, at SMB, all traders use a platform called TraderView to collect statistics on their trading. How many winning trades did they have? How many losing trades? What was the average size of their winning trade? How much heat do they take on their trades? How much money do they make in different trading styles or approaches? The keeping of statistics tells us objectively what we're doing well and what we're doing that needs to be improved. So that statistics help us set goals. They help us learn from our experience. Just trading and trading and trading is not necessarily effective practice. We need to figure out what we're doing well, what we're not doing well, and make changes in a deliberate practice mode, create goals so that we're constantly learning. But it's not enough to set goals. We have to turn those goals into specific plans. So it's not enough for me to have a goal that says, okay, tomorrow in my trading, I need to be more disciplined. Well, no. How am I going to do that? What's my plan for becoming more disciplined? Excellent goals energize us. They challenge us. They have to be very specific. They can't just be good intentions. And they must be very specific and doable. Having too many goals is almost the same as having no goals. We need to be able to focus on specific goals, specific plans, so that each day we're working very specifically to improve some aspect of our trading. Number 3, focusing on process. A general rule is that before traders can be profitable, they have to become consistent. And they become consistent by developing routine processes that make use of their strengths. Trading consists of multiple processes. We have processes for generating ideas. We have processes for managing positions. We have processes for managing risk. And as I point out at the bottom, we have processes, hopefully, to manage ourselves. We have a personal process that keeps us in our peak mode. When we study our successes, we can identify which parts of our processes are helping us and which might be hurting us. And so we can refine those processes. Successful traders have very routine ways of doing what they do, and then they can adapt those routines when, as we said, markets change. Best practice number 4, sustaining focus. The more active the trading, the more important it is that we have concentration and focus. And most of us cannot sustain ideal focus for a long period of time. We become fatigued. We become distracted. And so that's the importance of taking breaks in trading. In Chicago, where I started trading, traders would divide the trading day two trading days. There was a morning and there was an afternoon. And they would take a break in between. And they would keep a separate profit loss figure for their morning trading. And then they would have a separate profit loss for their afternoon trading. And during the break, they would prepare for the afternoon, just like early morning, they would prepare for the morning. They also had separate risk limits for their morning trading and their afternoon trading, which helped them make changes during the day during that noontime break. The importance of a calendar. We can schedule activities in our calendar that help us stay focused. Many traders I work with practice meditation. They use the Headspace app or something similar that teaches them how to meditate. Meditation helps us stay calm, but it also helps us sustain focus. And so they schedule in their calendar times when they want to do meditation so that they are renewing their concentration. They're not becoming distracted. They're not becoming fatigued. And finally, the importance of self-control exercises. Exercises, and meditation could be one, exercises that help us calm down when trading becomes emotional. Once we become emotional, our bodies go into what's called a flight or fight response. That can lead us to make impulsive decisions. So self-control exercises could be as simple as taking a break and walking around and getting away from the screen. It could be a visualization exercise where we use imagery to calm ourselves. It could be meditation. I know traders midday who take an exercise break. They do physical exercise as a way of renewing themselves. All of these are ways of getting out of a negative mindset and, in a sense, resetting. Next best practice, teamwork. This is very, very important. We're seeing this increasingly at hedge funds where traders don't work in solo, they develop teams. This is particularly true in macro trading. Teams work together to generate ideas. If different people on a team look at markets in different ways, they share their perceptions, they share their ideas, and that feeds the creativity process. At the firm that I mentioned, SMB, the teams share their trading reviews. Every day they're reviewing their trading, trading statistics at the end of the month, and they're sharing that with their other team members. They share it with me. They share it with their team leader as a way of getting feedback and accelerating their learning. That helps the team members stay accountable. They know that they're going to have to share the results with team members. And so that is an added incentive to do things well. Even when traders are trading independently, they can connect with other traders online to form their own virtual teams. You don't have to be working at a trading firm to be part of a team. You can identify traders who trade similarly to you, who you get along with, who you respect, and create your own team where you review markets at the beginning of the day and maybe review your performance at the end of the day and share ideas during the day. That becomes very helpful. And of course, there are trading communities that have formed online that serve this function as well. Practice number 6, crawl, walk, run. First, we learn in simulation mode. We learn trading through practice trading. Simulation is trading on a platform where we can place our trades, but we're not risking any money. They're practice trades, and the platform can keep score for us. Many different trading platforms have that capacity. so that we can try out different ways of trading, make lots of mistakes in the beginning, as beginners do, and not lose any money because we're trading in practice. Only when we're able to make money consistently in practice trading do we go live and start trading small. Going live introduces some performance pressures, and so we want to start small so that we don't lose too much money beginning. We want to make all our mistakes either when we're practice trading or when we're trading small. Then, as we sustain consistency, we can increase our risk taking as we have good results. So that's what I mean by crawl, walk, run. You start slow and then you grow your trading. The big idea here is that you first build consistency in your trading, and only then do you build size of your positions. Many traders fail because they try trading too large too soon. Let me conclude by emphasizing this issue of strengths. In some degree, you are already the trader that you are seeking to become. When you study your winning trades, you are learning about yourself as a successful trader. You're figuring out what your strengths are, what you do well. The idea is not to copy the trading of other people. The idea is to discover what you do well. And yes, you can learn ideas from other people, and that's what mentoring is all about. But at the end of the day, you have to apply it yourself based on your personality strengths, your cognitive strengths. And by reviewing your trading, keeping statistics, working with teams, you can become more and more grounded in who you are and what you do well. That's what I see among successful traders. I would be delighted to take questions and entertain discussion in any way.
Let's look at the questions from our audience and participants. And as we wait, maybe Brett, you can, because you've worked with funds and hedge funds and institutions, maybe you can tell us the differences that you observe in traders who are trading manually and those who are trading systematically using automated trading tools such as expert advisors.
Yes, it's a very good question. These systematic traders I work with, the quantitative traders, they have strengths analytically. They are able to analyze markets historically to look for patterns, and they're able to program those patterns to give them ideas for trading. So analysis becomes a big part of their strengths and their trading. The discretionary trader is really focusing on pattern recognition, recognizing patterns in markets, using data, economic data, geopolitical data, data from monetary parties to develop some ideas, but then looking for patterns to tell them how they can trade those ideas. So their skill is pattern recognition of the quantitative trader. What we're seeing increasingly are traders who are both discretionary and manual and systematic. They do analysis, they construct models to give them ideas, and they trade them in a discretionary way. Those are called hybrid traders. It's become quite common.
All right, thank you, Brett. Thank you, Brett, for that.
Sure.
Actually, I'm getting a comment from people that your voice is breaking up a bit. So maybe if you could repeat the answer to that question, the one that Sylvia asked regarding systematic trading.
Okay, so repeat about discretionary and systematic trading.
All right, for pattern recognition between manual trading and quantitative trading, maybe the use of automated systems.
Yes, yes. And those reflect different strengths, different things that people are good at. Pattern recognition requires fast thinking. It often is very visual, and it requires the ability to synthesize information, to put information together quickly from different sources. So they may see something happening in the news, they see something happening on a longer time frame, they see something happening on a shorter time frame, and it all lines up for them and they place a trade. That's an example of pattern recognition. Quantitative trading is based on formal analysis. So they are doing mathematical analyses of historical patterns in data, historical relationships among variables, and they're constructing formal models that tell them when to buy and sell based upon market history. And so they're not involved so much in the moment-to-moment pattern recognition. In fact, they may let the computer just place the trades for them. That takes strengths of analysis. It takes strengths in terms of building and following models. What I've seen recently is that many traders at professional trading firms are both discretionary and quantitative. They study market history, they get signals from models that they build based on research, and then they trade those signals in a discretionary way using their pattern recognition. Those are called hybrid traders, and they have been very successful in many cases.
All right, thank you for that. So I have one question for you. Earlier on, when you were talking about trading psychology, you said that successful traders are able to adapt to the environment. Maybe you could give us an example of a trader that you've worked with who was able to adapt to a certain market condition and they were able to successfully pull it through.
Yes, good question. So the people I work with at hedge funds, they may hold many different positions in different markets. They may hold currency positions, interest rate positions, positions in the equity markets, and that creates their portfolio. When markets become more volatile, we see correlations among markets increase, so that people who thought they had a diversified portfolio now all of a sudden find that their positions are riskier than they thought because there's more volatility, and they find that their positions are moving the same way because correlations increase. This happened recently with the trading around the virus in China. Markets became more volatile and correlations increased. And so the successful money managers recognize this and adapt their trading to make sure they're not taking too much risk with the market becoming more volatile. We see day traders also doing the same thing, adapting to the volatility of market conditions. So for instance, they may be making their money from trading individual stocks, but when the market becomes more volatile, they adapt and trade the market indexes as their primary vehicle. They also size their positions differently in low volatility markets and high volatility markets because positions will obviously move more in the volatile environments. So those are examples of how we can adapt to changing market conditions.
All right, thank you for that. I have a question from one of the guests, or actually one of the people who are tuning in, and they're asking, what ways can you be able to build on your discipline when it comes to following your trading rules?
It's a common question. There are a few different ways of doing that. One is to create from your trading rules an actual checklist. The checklist describes to every one of your rules and what you're supposed to do. And you do not allow yourself to place a trade until you have been able to check off each of those items. This is what airline pilots do to maintain safety. Before they can take the plane in the air, they have to fill out a checklist to make sure that the engine is okay, to make sure that the weight is distributed properly within the aircraft, to make sure they have the right amount of fuel. And it's because they require themselves to complete these checklists that they have a good safety record. We can use checklists based on our best practices that make us safe, just like the airlines are safe. And that keeps us grounded in our best rules and our best practices. We can also mentally rehearse the checklists before we start trading to make sure that those are at the front of our minds.
All right, that's very good advice. I have another person who's talking about correlation and how we can best use correlation as a way of being able to manage the risks in our trading. Should we use positive correlation or negative correlation, or should we just have a hybrid?
Correlation is most important if you're trading a portfolio. If you're trading many positions, if you're holding many positions at one time. What an understanding of correlation does is allow you to be diversified. Diversification means that you're taking many different risks, so that when one position might be losing money, another one could be making money. So you want positions in your portfolio that are negatively correlated or not correlated. So for instance, you may have a position in the overall stock market, a bullish position, but then you have a completely uncorrelated trade in natural gas futures. It's a completely different market, moves on different factors. And if you are doing unique and good research in both areas, then you are spreading your risk and making sure that you're not too concentrated in the risks that you're taking. Another way that a day trader could use correlation is by understanding which stocks move with the overall market. And so, or which currency pairs move with the major currency pairs. So you can compute the correlations of daily returns, and let's say you think that the overall market, stock market, is going up, but you see that Apple, the company, their stock is performing better and is very highly correlated to the overall market. You can use that correlation market to trade Apple rather than trade the overall market and increase your profitability.
All right, thank you for that. We also have another question regarding trading psychology. What are the main psychological obstacles when it comes to successful trading?
The main psychological obstacle is that people start trading before they know what they're doing. A lot of traders think that they're going to just look at a few charts and they can start trading and taking risk. That is absolutely ridiculous. There is no field of performance where we can just start in the first days or weeks and suddenly achieve professional results. we don't practice some sport in athletics. Imagine practicing boxing or practicing basketball or practicing football for a few weeks and then thinking that you're going to make a living from it. It's ridiculous. Traders put on risk way too early. They're looking to trading to make quick money, not to develop themselves and their ability to read markets. That is far and away the biggest source of problems for traders. It's why they become overly emotional. They're taking risk way too early. They're taking way too much risk too early.
All right, thank you for that. Maybe just any advice that you could give to people who are struggling with drawdowns, having maybe losing streaks, or maybe they took in too much risk and now they're holding on to sizable drawdowns. What are the holistic approaches that you could advise someone to take in order for them to be able to manage that kind of a situation?
If a trader has gone through very big drawdowns and now has lost most of their money, that can have a very big psychological effect on them. I wrote an article on my blog, TraderFeed, recently about trauma and trading. Large losses can traumatize a trader. That's why risk management is so important. If I took very large losses in my trading, I would want to step back, stop trading altogether. Just stop trading and then slowly work on regaining my frame of mind and slowly restart my learning process. I would go back to practice trading. I would build my consistency. I would go right back to the very beginning, build my consistency, and then only gradually take risk. This is why risk management is the best psychological practice of all, because we don't want to lose so much money that we end up hurting our psychology.
All right, thank you for that. Any confidence building strategies or activities you may recommend?
In general, traders have too much confidence. They think that they can look at charts and make money. Traders often need more awareness of the risks of trading. They don't necessarily need more confidence. But what does build more confidence is that practice trading. When we practice what we do and learn from our mistakes and get better and get better and get better, that does build confidence, and it builds the right kind of confidence because it's based on experience. It's based on our experience. That's the right way to build confidence. Confidence is not the feeling that you're going to win. Confidence is the reassurance that you know how to deal with losses when they occur and that you can keep yourself focused doing the right things. But that takes a good amount of practice. It's the same way people build confidence in learning a sport. They build confidence learning a sport by practicing, working out, drilling, getting coaching. That's how they build confidence, by gaining experience.
All right, thank you for that. Regarding the recording of trades, the trading journal, what are the key elements that, based off of your work, you realize that are essential in being able to record your transactions properly? So that is not just the numerical part, but any other information that you'd also need to record on your trading journal? Yes,
a very important question, and something I've addressed in my books. If you go to Google and you just look up TraderFeed and journals, you'll see articles I've written on this topic, and that's true for any topic. If you go to Google and type in TraderFeed and whatever topic you're interested in, I've written over 5,000 articles that are on the blog. Chances are there's something on the blog and certainly something in the books I've written. In terms of trading journal, the simplest journal that I recommend is every day writing down in detail, what did you do well that you want to continue tomorrow? And what did you not do well? What did you do poorly that you want to improve tomorrow? That's it. 2 things. What did you do well that you want to repeat tomorrow? What did you do poorly that you want to improve? And how will you improve it? In other words, like we said, making a plan, not just setting a vague goal. That can be a very effective start to a journal.
All right, thank you for that. We have a question coming in regarding the best timeframes for analysis. So this is mostly for new traders. What is the best time frame for analysis that you would recommend or advise?
The best time frames are multiple time frames. In other words, if you are looking for market patterns, you want to see those patterns showing up on the shorter time frame and on the longer time frame. Some traders are very good at fast thinking and fast processing, and so they may look at short patterns on a 1-minute chart. And a longer pattern may be something that occurs over hours or a day or two. Other traders are not so good at the fast thinking and are looking for larger patterns and slower patterns in markets. And so their shorter time frame might be a swing period of several days, but then they're looking at a longer time frame of perhaps weeks to months. But the idea is that the trading opportunities come when we line up the shorter time period and the longer time period, and we see something consistent happening across multiple time frames.
All right, thank you for that. I think there's also another question regarding the kind of returns to expect as a new trader or as a small trader. Based off of your experience, what do you think is a realistic return on investment when it comes to trading stocks and maybe also in Forex?
If a new trader, a developing trader, is focused on their returns, they're going to fail. It's absolutely the wrong question to ask. You want to build the consistency first in your practice trading. You don't want to put your money at risk in the beginning. You want to practice trading until you become consistent, and only then put small amounts of risk at work. And so you have to have a way of supporting yourself during the learning process. If you try focusing on returns and putting on larger positions early on, you're going to lose too much money. The success rate of new day traders, there's research on it. You can see it on my blog. The success rate is something on the order of 1 or 2 or 3%. More than 90% of beginning day traders lose their money. And it's because they approach the learning in the wrong way. Now, once a trader is experienced, once a trader has gone through their learning curve, then I think it's a good question. How much money can we make from our trading? I can tell you in the hedge fund world, if a trader is consistently making 10% or more on their money without drawing down very much, they will always have a long and successful career, particularly if they're trading unique strategies. But they are not trying, in professional trading circles, they're not trying to double their money every year, and they're not taking the crazy kind of risks that are necessary to even try to do that, and that's what allows them to stay in business. So I think a reasonable return for an experienced trader is going to be in double-digit percentages. And the importance is not just the size of how much they make, but the risk-adjusted returns. How much drawdown are they taking to make their returns? Being consistent and making money consistently, even if it's not a huge percentage, will make you successful, because you can always join a proprietary trading firm, you can join a hedge fund, you can gather assets to trade, grow the amount of money that you trade, and making a reasonable percentage will make you quite successful.
All right, thank you for that answer. We also have another question regarding the account size. What type of account sizes have you seen when it comes to small traders in the Forex world? What type of account sizes would you consider should be the minimum?
Yes. So in the beginning, you don't need much of an account size at all because you're doing practice trading. So for new traders, you don't need a large account size at all. If you're hoping to make a living from trading, then you need a large account size because otherwise you're taking too much risk with your money. And eventually, if you go through an expectable series of losses, you'll lose money or lose most of your money. I'll say something that the listeners may not like, but I work with traders in Forex markets, in currency markets, at hedge funds, and I see the type of information they get to be successful, information about central bank policies, information about changing interest rates, the information about shifting trade, macroeconomic information from each country, and all of this information that is important in driving investment flows in different currencies. The average trader does not have access to that information, and that's why the success rate of trading for new traders in Forex is unbelievably low.
Thank you for that. Maybe one more question, the last question. There's someone who's asking, between fundamental analysis and technical analysis, which one would you believe is superior, or should a trader have a blend of both?
It's a good question, and I would say the longer the time frame of the trading, and certainly if you're investing, then fundamental information is very important. If you're day trading, holding positions for minutes at a time, then the fundamentals don't really change during that period, and so the fundamental information becomes less important. And it's more about pattern recognition with the price action. So it really depends on the time frame that you're trading, the style that you're trading. But in general, I would say that fundamental information is important to how currency markets move. And the successful portfolio managers I work with do gather a lot of information fundamentally about economies and interest rates and monetary policies to understand what is making currencies move. That's less important if you're just doing very short-term day trading.
All right, thank you for that. I believe this comes to the end of the Q&A session.
Good. Well, I appreciate the opportunity to be with you. And by the way, recently, it was toward the end of 2019, I did a series of blog posts on how to trade, and you'll see the kind of technical information, other flow information that I use and look at that I think could be helpful to your traders. I appreciate the opportunity to speak with you and the audience, and I wish you the best of luck in your learning process. Trading can be very fulfilling. Trading can be very successful if we approach the learning process the right way.
Thanks guys for tuning in and sticking with us to the end. We hope you have learned something new. I would like to appreciate Scope Markets for sponsoring this webinar. Remember, you can open a live trading account with Scope Markets and apply the lessons shared by the guest in this webinar to your trading. Many thanks to our guests for speaking to us. We'll be open to have you in the future. Till next time, goodbye.